Hey everyone. Today we're going to crush out a little bit of an overview of the market and look at what the Fed might be changing that they haven't told us yet. Let's get right into it. All right, so as we can look at here, we can pretty much see where the SPX is pushing up into our upper targets. We've talked about this, on the adapt advance meetings and things like that. So we know that that's pretty much where we were expected to go. Plus, we've got a little bit of a supply line up here. Where are things going to go? Well, let's start looking at some of the macros just to see where those are pointing at, and then maybe that'll give us an idea of what's next on the horizon. First things first, we're going to look at the reverse repo market. We've been talking about this for a long time now that as this guy drains, this is new money entering into the financial system, pumping things up. It's been doing that ever since roughly end of May, early June of 2023. That has been cranking the market up even as the economy has started to slow down and kind of pull down and just go into this light recession that we've been in economically, but not financially. And that's due to a massive amount of stimulus. Roughly, what about almost 2 trillion has been leaked into the reverse repo market. Now, the second part of this, as far as monetary policy, right? Are we printing money and putting it into the financial market, or are we taking it away? Remember, the Fed has been saying that they've been tightening, which interest rates, sure, but as far as outright just printing money, buying assets, and putting it in things like that, they started using this reverse repo market in the background. But then also, and this is what has started to slowly change. So we're going to see kind of going on here, and we'll dig in a little bit more into their weekly summary and see kind of maybe this money is starting to show up. So as you can see here, this is the COVID little mix, right? We've talked about this before. COVID mix running up. And then, of course, this is about when, around here or so, is when they started to print excess beyond what the banks could even handle as far as liquidity needs. And then that's when they started stuffing it into the reverse repo market to use for later when there's not enough hand for treasuries, which has been what's been going on. Now, they started to quote unquote tighten their balance sheet, or basically sell off their balance sheet, which they have on their outright balance sheet because they, printed excess earlier. Anyway, so basically that excess has almost been used up. And right when that excess is starting to be used up, what are we noticing here? Yeah, we're starting to see a little bit of a curvature of a reverse. They haven't said that they're turning anything around yet. They haven't stated anything on any of their press releases or even at their meetings or anything like that, even signaling that they were going to stop their quantitative tightening. So why is this going on? Well, let's dig in and maybe we can kind of see where it's going on. And if not, we'll just see what kind of goes on in the future as far as where the Fed's going to point us to. But either way, this is stimulative. That means possibly even more up in the market. I know the market's been going straight up like the heck. Well, our macro indicators keep on saying bullish, bullish, even though we've got GDP contracting. So it's just the amount of stimulus that's coming in is overwhelming the system and pushing assets straight up. So let's dig right into what the Fed's statements are saying. So this is the factors affecting reserve balances of depository institutions. Big long name, but basically it's what's affecting the Federal Reserve balance sheets, right? So what are they doing? You can see here we've got reserve bank credit, we've got treasury securities, whether they're selling them or buying them. They are selling them, right? And you can see here, 704,000. And then also you can see here, 630,000, right? You can see, mortgage-backed securities. So they are selling things. Now, this is, of course, going back a little bit. This is January 11th. And what we're looking for is change, right? What's changing? Why is this not going at the same rate that it's been going? So what's kind of helping it up just a little bit, right? Are they adding to their balance sheet anywhere? Because they are saying that they're still selling, right? So where is the new money coming in? Where, what's going on? Are they making money from? All right, so let's dive right into it. And one of the things that is positive on their balance sheet that they're making money from, right? Here's 135,000 right here coming in from loans. And then here is a bank term funding 144, right? So of course, something to think of. And of course, remember, these are in millions of dollars, right? So this is quite a bit of money here. It's not just 135,000. right? So the Bank Term Funding Program, which is basically banks that don't have, banks that need extra cash, right? And then they end up having a loan, and then they pay back for them. A lot of the time, this happens because, hey, I need cash, right? A bank says I need cash, and then says, hey, uh, no one else is going to loan to me at a rate that I can actually withstand because I'm going to go under, right? Or no one's willing to loan to me at all because all my collateral is really garbage, right? Basically, they've got a bunch of treasuries that are just total shit. And so, what do? Right? Well, the federal government has a program in which they will give you a loan of the face value with the value of your collateral. So basically, if I had, $200 billion in T bills that are now underwater because rates have gone up so much, they will say, "Hey, how much did you buy them for? We will we'll give full value for that, but we're going to charge you a little bit of interest on that, right?" And now it's not as much as what the open market would do. So anyway, so this is kind of what these lending programs are. So these are balances that are adding, right? And they're adding. And so is that going up or is that going down? Are more banks using that lending program or are less banks? And you can see here over the next couple of weeks, right? We went from just like kind of looking here, right? We went 135 in loans, 144. Now we're going to 144, 154, right? Then we're going to 154, 164. It's creeping up, up and up and up. That means the federal government is starting to make money on those loans, right? That bank term lending program, those types of things. They're adding to their balance sheet. Those are not negative things. So keep in mind that that is what's kind of affecting the underlying. So we're starting to see possibly some cracks in the underlying financial system, and that's adding to the Fed's balance sheet, even though they're selling treasuries, right? Inevitably, they're not going to be able to keep this up, right? And the Feds are going to collapse, or they'll have to absorb each other, or we'll have some sort of financial crisis or something like that. But in the meantime, we've still got money in the reverse repo market that's still draining out, right? We do have a small inkling possibility of some positive GDP this quarter, right? Even though it's still contracting, but it could be slightly positive. So overall, there is a little bit of positivity, but at the same time, we're starting to see the cracks form, give us a little bit of an idea that we could start possibly seeing a downturn sometime soon. On a technical basis, just to overview this, we have gotten to these targets, right? So this is one of our targets that we were looking at in the Adapt Advanced. And that does typically correlate with some sort of, sideways-ish. And then also the fact that we're up at the upper end on our supply line on our Wyckoff channel, right? So just like up here, when we start running into these, we can start getting some chops like we did last time, or we can get some really kind of just cools off for a little bit and then maybe a small pullback, right? So we could get a little bit of cool off, small pullback. But if these cracks start to show up more and more and more, that could be the next catalyst for a full down move over the full Wyckoff channel. And it could end up actually be the beginning of this second stage of the recession that we've kind of been waiting for, that this amount of printing that they started doing back here really has been trying to kind of push off to the side, and we've been inflating U.S. assets. So let's see what goes on, but it should be fun, and let's have some good time trading.